under $85, and WTI is trading slightly under $81 per barrel. Oil prices fell for a second day as US crude oil inventories rose this week, while we had recently the Ukrainian drone attack on Russian oil refineries. And I'm happy to welcome James McCallum, CEO and chairman of Exergy Group and professor of energy at Strathclyde University, Peter Maguire, chief executive officer of XMCom, who is joining us from Sydney in Australia, and Jamal Qureshi, the managing director of strategy and analysis at Petro Logistics, who is joining us from Norway. Let me start with you, Jamal. Russia is contending with recent drone attacks on its oil refineries by Ukraine. I would like to get your perspective on it. What is the impact of refining disruptions on crude prices?
Well, obviously, when it comes on the product side, it's both indirect and direct. Direct in the sense of it's a psychological impact. It's going to, anytime you see infrastructure knocked out, that's going to impact, especially for paper traders. On the physical side, it's indirect, obviously, in the sense that you're actually going to have more crude available on the market. We are seeing signs that the crude exports will pick up. But in favor as opposed to the products, but of course then somebody else has to refine that crude. But it's a multi-step process in that case. So, but for the short term, yeah, obviously we've seen the pops on the flat price as a result.
Goldman Sachs said that it had knocked about 900,000 barrels per day of capacity offline, possibly for weeks or even longer.
Yeah, no, at its peak, which we're close to right now, it looks like we're waiting for some final confirmation, but it looks like some of the capacity at Ryazan may have started to come back. But in general, yes, it's up there. It's in that sort of ballpark, 800-900 KBD, depending on the day.
Are we going to see a further impact on oil prices for it?
I mean, I think probably the biggest question will be, as far as near-term impact, whether this could lead to other product export bans. They've got a gasoline product export ban on right now. The volumes for gasoline versus gas oil aren't anywhere near as large, just structurally. If that starts to hit into gas oil and any other particular products, then we certainly could see more impact.
Peter Maguire, Chief Executive Officer of XM Australia, commodity demand is set to increase this year, driven by interest rate cuts by central banks. And according to reports, apparently we could see potential commodity returns as high as 15%. Gold has hit its highs. Oil prices also had it higher in recent weeks. And OPEC Plus is holding an online meeting next week to review the market and members' implementations of output cuts. I would like to get your thoughts about OPEC going to adjust its output policy, whether it is going to be like this or not, and how do you see the oil prices evolving as we are getting into the second quarter of the year, but also on commodity prices?
Yes, exactly. And I welcome Eva, and nice to join you from Sydney, Australia. As we put the first 3 months to bed and Easter this Friday, it's been quite an extraordinary time. As you mentioned, for gold, if you like the likes of the commodity sector, some of those, if you look at the price of cocoa for chocolate, it's more expensive now than copper. It's been ballistic and absolutely parabolic over the last couple of months. So there's just an example. Now, as we work through, and as you said, as far as the OPEC situation, I feel as though second quarter you'll see an increase as far as demand. It's not unusual, and probably driving season and a lot of other conditions that are going to, I think, ramp up demand. And where OPEC sits, I think they'll probably, I don't suggest they're going to change anything, because I feel as though that the prices really haven't materialized to where they would be absolutely happy, and that's probably closer to 90. And it's whipsawed very much since really what we saw at the start of October. You're looking at the gold market, we're only $28, $30 off an all-time high. We're just sitting right now at around about $2,199. So it's very, very strong, and we've got many central banks that are looking at cutting sometime over the next 3 months. Is it going to be 3 cuts for the Fed? How's that going to impact as far as equity markets? We've got huge demand for equities. If you're looking at Japan and certainly the US have just at record highs. So there we talk as, you know, strong growth. And so I'm not expecting any surprises coming from OPEC. Sit here from a trading perspective, and I'm suggesting we're going to be stronger over the next 3 months than where we are at this present time.
Jamal, Russia's government ordered companies to cut output in the second quarter to meet a 9 million barrels per day target and comply with pledges to OPEC Plus. How much these Russian cuts influence crude prices as well? Your thoughts about it?
I think one of the most interesting things there is that Russia's participation in OPEC Plus, you know, over the past year has actually been very, very vague. They changed, you know, the nature of their cuts. Was it going to be crude? Was it going to be products? Was it going to be exports? Was it going to be production? And, you know, when you dig into it, actually, it's really hard to nail down what they were doing. The recent announcements, they've actually, over the course and, you know, by June, they're going to be back to a clear crude production ceiling that they're going to be setting to get to that 9 number. By our calculations, that would probably require a 400 to 500 KBD actual production cut. That seems perfectly plausible that they could do that. They have largely kept in line with what they've said they would do. The interesting thing on that too would be if refineries continue to be down in these fairly large volumes, obviously there's going to be more crude in theory available, but that might stretch infrastructure in specific places. So tailing back some production at the wellhead might actually be something that could make some short-term sense in terms of managing the logistics of it. So it's possible. Of course, there's all the unknowns between here and then in terms of attacks and repairs, but it's certainly not outlandish.
On the other hand, Russia continues trading its crude using the gray and black fleet, and it seems that Oman is becoming the hotspot for trading Russian oil. Can you tell us more about these flows?
Yeah, sure. Well, it's interesting too in that there's been some switches. India, obviously, after 2022, went from bringing in almost no Russian crude to huge volumes. And now they've said, you know, the Indian refiners have all said they're not going to take anything off of Sovcomflot, that the Russian fleet there. So that's, you know, we've already seen the Indians back off a little bit, and that's likely to continue. We'll probably see more STS at sea transfers as a result of some of the sanctions enforcement getting tighter. So all of which just says, yeah, there has to be some extra work by the Russians done if they want to place their barrels. But you know, they tend to find ways. Some of those they had a lot of so-called cargoes that kind of got stranded, in particular with regards to making it to Indian clients, but they found their way back Singapore and then apparently into China, it looks like. So they're good at finding ways to make the crude flow.
Exactly, and recently, apparently, Oman is one of these places also. James McCallum, CEO and Chairman of Exergi Group, I'm coming to you with this big question. I would like to get your insights about upstream activities this year. OPEC Secretary General said that the oil industry will need investments of $11.1 trillion by 2045 in exploration and production to ensure stable supply and as energy demand is growing. By the way, the growing demand was also a hot subject last week in Houston at CERAWeek conference. How do you see upstream activities evolving in the short and mid-term?
So that's a really good question, Eva. Thank you for asking it. I guess there are there's lots of talk about will US production increase. There's an ongoing debate about the role in terms of the production numbers that OPEC are setting through to 2045 that will come from the IOCs versus the national oil companies. And I guess you've asked what I think I see in the short term in terms of activity. We've got Saudi production off the market just now, which could come back onto the market. We've got supply disruption in Russia, primarily on the part of the damage caused to the refineries. And then we've got a US election coming up. So I guess for me, if you take a look at what I think is the primary driver in terms of where oil price will be and therefore what will drive activity, we've got the US election coming up. We've got a marketplace there that doesn't want to see oil prices going much higher than it is right now. And indeed, in terms of the drone attacks by Ukraine onto Russia, the United States has asked Ukraine to back off on that because obviously the potential impact that has on increasing oil prices, therefore negative effect on the markets. We've just had CERA week in Houston last week, and of course we've had all the super majors in the room, all the major contractors in the room, and there the message very, very strongly that the world is swinging back towards an energy security discussion rather than, if you like, a sustainability or renewable agenda that's there. So let's take a look at what's actually happening on the markets. Record markets, S&P 500, record markets in terms of the general trading equities markets out there, oil prices creeping up. But let's look at the oil and gas companies and the contractors and see what's actually happening on the ground. So rig count, Baker Hughes rig count's just now kicking around about 624, off 5 on the week. Interestingly, I guess if you ask most market analysts, where do you think that is on a year ago? They might think it's probably flat or up. It's off 134 rigs in the United States market. And just to give that some kind of a perspective of where it's been historically, that's off from about 1,400 as a peak when major drilling activities in the Permian Basin were absolutely flat out for the contractors. So what's that doing to the major service companies? Well, the onshore drilling contractors, are not having a good time of it. Their share prices are off very, very significantly on 5 years ago, anywhere between sort of 20% and 50%. Their share prices are off on 5 years ago, and a long way off from their record share prices in 2014. So what about the super majors? Super majors pretty flat, actually. There's no massive uptick in share prices. Yes, they're back to pre-COVID levels, certainly from where they're at. But they're at roughly where they were around about then. So what that says to me is that things are going to stay pretty much in the international markets and the IOC markets as they are just now. And that is, focusing on dividend policy, focusing on giving value back to shareholders, not particularly investing in significant capex either domestically or around the world. There'll be some, but they'll continue to consolidate the market. And so I think we'll see relatively flat activity through the course of this year in terms of the IOCs, and the national oil companies will simply respond to the OPEC call.
And staying on the ground, as you said very well, we have this report saying that the upstream FIDs are to increase in 2024 with focus on deep water resources. Reports from consultancies like Wood Mackenzie or Rystad say project activity will increase this year with a total around of like $120 billion in investments. Do you know which region would be the driver of these FIDs, whether it is Middle East or South America? Or
to be honest, I think where it will come is the focus on that, and those numbers coming out there are principally around super major activity, and the super majors are going after elephant structures. That's the only place that they're really focusing in on. Obviously, in the United States, there's recompletions, working over wells, et cetera, which is why when you look at the major service companies like Schlumberger, Halliburton, Baker Hughes, where the drilling contractors haven't kicked up at all, the service companies have kind of sort of seen a sort of steady state. They're off from the records of 2014 in terms of where their share prices were, but they're steadily creeping up because it's the service companies that do the workovers and the recompletions on existing wells. And that's what the Permian Basin is primarily about in terms of its activity levels in increasing production over the next year. For the big international super majors, it's deep water, it's off Guyana, et cetera, It's that kind of activity. That's very expensive activity, but it's worth remembering it's also very long in terms of its time delay, in terms of coming through on delivery. So that's where, if there are funds coming through from a steady oil price at around about $85 a barrel, which is flowing, solid revenues back into the super majors, that's where they'll spend their incremental capex.
And what are the reasons of this, growing numbers of FIDs? Is it going to be enough actually to sustain energy security?
Yeah, the world is not running out of oil, and I think that's the point which is repeatedly made. In fact, in CERA, that point was made very emphatically, perhaps too emphatically. Clearly, I think Andy Critchlow made some good comments, and Adi on Monday's talk. What I think is shifting, and I guess it'd be interesting to see what the other speakers feel about this, is if you look back to 2021, early 22, you had super majors, particularly European super majors, taking a very strong thought leadership position on energy sustainability, sort of like moving across into energy diversification and the energy transition story. The United States super majors, the Exxons, the Chevrons of this world, not taking that particular stance. And the European super majors were punished for that in the markets, and what we've seen, of course, as a consequence of that, as they've sought to close the gap on their American counterparts, they have swung back towards focusing on what their traditional marketplace has been, which is hydrocarbon production. And that's what we're seeing. Their share price is now coming closer up. Exxon, perhaps the bellwether of the US super majors, trading at its all-time high right now. Compare that to the companies in Europe that have stayed in the energy transition story. Ørsted, Equinor, their share prices are significantly off from their peaks. So what we're seeing is super major IOCs transitioning back towards hydrocarbon-based activity to boost their revenues and to satisfy their shareholders. And that activity will be in the FIDs, which are deep water. And I think the European super majors themselves changing the rhetoric around where they want their focus to be. For me, I have to say that is a bit concerning, because, of course, the story going forward is not just one of energy security. It is also one around energy transition. And as a 40-year veteran in the oil and gas industry, I had hoped that we would see at least a steady stream of thought leadership coming out of our industry and in that space. And I would suggest that that we're waning from the positions that we were taking in 2021, and that concerns me.
Peter, I would like to have your thoughts about it, but before I ask you about it, let's have a survey question. We should get it shortly. Which will have the biggest influence in oil markets in the second quarter of 2024? Make your choice. Is it going to be geopolitics, OPEC plus supply cuts, China outlook, or US economic outlook? So yes, Peter, please tell me your thoughts about what James is saying.
Oh, look, I'm building on James. I mean, that, as we know, we're not running out of oil. And this is where the whole argument comes from. Alternatives, where we move forward, the electric vehicle story, what's happening as far as consumption, a country like Australia. Should we have significantly greater, I mean, the landmass of the country, we've got deserts, and we're surrounded by oceans. Should we have solar from here to Perth, a 4,000-kilometre, just solar farms? What should we do as far as gas production? Where does Australia play in all of this? I mean, we're a powerhouse when it comes to commodities, from iron ore to what we can grow in the ground to what we can retrieve from the ground, from diamonds to gold to all things energy. So I think that we are in a very interesting phase of markets and where we look at from a retail perspective, because I think it's the attraction. As James said, you're down 130 rig count on Baker Hughes. You had a high there in 14, I think it was around 1,400, and where you are at the moment. So what do we have to do to get those drillers back in? Is it going to be price that's going to drive it? Is it going to be 105 WTI that guys say, hey, I'm giving the bar job away and I'm going back to wildcatting, man. I'm going to, this is where the attraction is. So, all of those drivers, I think, are going to be interesting if we do see higher prices, which I think we're forecasting pretty much in the second and third quarter. I think there's a lot of big themes that are going to play out over the next couple of months leading into an election cycle. And I think it's going to be quite fascinating from a volatility perspective.
Jamal, do you want to comment on it also?
Sorry, say that again?
Do you want to comment also on it?
On energy transition type issues you're talking about. Yeah. Well, I mean, I think the politics of it is interesting simply because I look in particular to U.S. politics and the volatility that we're seeing there. As the conversation has shifted so strongly to the supposed failure of the electric vehicle transition, and at the same time, you've got populist chaos in sort of both parties. There's this real ability to shift the incentives that can occur to cause those short to medium term hiccups that we've seen have changed the story so much. With the election coming up, okay, fine. The Biden administration has a set of policies that are kind of locked in at this point. But what we've certainly seen is that, with Trump, while he may be personally volatile, there's a fairly predictable set of sort of Republican strategies that can come in on sort of the policy and bureaucratic side that could, further kind of trip things up as you go forward. If there were a new Trump administration, or even if it wasn't Trump, any Republican administration, if we get some sort of chaos between Biden and Trump as his candidates. So I do think we need to look at what may be happening over the course of the next 12 months politically in the U.S. as something that could have a significant impact on where companies go in terms of, as Mr. McCallum said, in terms of thought leadership. Because I think the tone could have a big shift once the U.S. election comes through. For now, yeah, we're probably locked in for the near term. But there's a lot that's going to be happening in geopolitics that can have a significant change over the course of the next year.
James, on another subject about the trade flows disruptions, it seems that it continues. Yesterday, the Francis Scott Key Bridge in Baltimore collapsed in Maryland after being struck by a large cargo ship. Closer to us in the region and closer to energy flows, the Red Sea shipping volumes have slumped more than 60% since November, as vessels opt for the longer route around the Cape to avoid Houthi attacks. So what is the general impact of all of this on supply chains?
Was that to me, Eva?
Yes.
Yeah, okay, thank you. Well, disruptions like that are very short-term impact events. In fact, if you take a look at, the volume of flows, which I think are actually nearer to 70%, which are now going around the Cape, when that disruption first happened, yes, it had an impact on prices, but those cargo ships are now arriving, and of course once they arrive steadily, one behind the other, and so that impact on the markets falls away relatively quickly. And that's what we're actually seeing, particularly in terms of refined products. I think there's perhaps a greater focus at the present moment in time in terms of what's actually happening in terms of Russian refinery capacity, but then offsetting it against what's actually happening in terms of the likes of Indian and mid-Asian capacity, refining capacity coming onto the market. So one's coming off, another one's coming on. Russia, obviously a major supplier of diesel, will we see an impact in that particular space? But then again, refining capacity of diesel coming out of mid-Asia, increasing, so the reality is these kind of transport infrastructure events are sort of a flash up and then a sort of a tail away. And I think at the present moment in time, they're having relatively little impact in terms of prices on the market.
I might add a quick comment there.
Yes, of course.
No, I think it's interesting too, because what we're seeing is, okay, what's happening in the Bab el Mandeb kind of coincides with a lot of these refinery capacity developments. And the result has been less sort of, Pacific or east of Suez, west of Suez trade. We can talk about how things are going around the Cape. That's absolutely true, but there's also been a net decline in that east-west trade. The Bab el-Mandab was obviously the immediate cause. We may see changes on that over the course of the next 6 months. We'll see. But there's been some real big changes that have occurred there. So whether we're talking all the way far east to Guangdong, but more closer to home, the Azor refinery in Kuwait, I mean, that is causing a significant structural change in Kuwaiti exports and the Kuwaiti export profile. But you take that, you take increasing Iraqi refinery runs, you take Duqm in Oman, and one of the big ones that I'm surprised we don't hear more about. I mean, it's out there in the industry, but it seems like it's not a big part of the conversation oftentimes, is the Dangote refinery in Nigeria. That is a complete sea change in product markets. West Africa has kind of been this final landing place for products that couldn't find a home anywhere else for decades. All of a sudden, West Africa on net, especially with new Ghanaian refining capacity coming on as well, is going to be self-sufficient and even exporting some product. That's a complete change in flows. So you've got all this extra Mideast refining capacity, Indian, Chinese, all of this that's competing, for a market that doesn't exist anymore, along with US and European refiners. So you get this increased regionalization as opposed to the broader east-west flows. So, and that coincided with the politics of the Houthis in the Red Sea and Gaza.
And it seems that, JP Morgan, for example, has estimated that Russia's refinery capacity outages could add a significant risk premium to the middle distillates market.
Yeah, no, absolutely. I mean, that's the key markets obviously are going to be for the Russian products is the diesel. The Karachi refinery, one of the largest exporters of gas oil, has not been hit yet, but it has been attacked. We've seen that the Russians have gone to gas oil export bans, and that could definitely happen again, if the balances get tight enough. We have to see how things develop. But that's if you tighten up diesel, you will tighten up sort of the broader market as well.
So let's have the results of the survey question before we wrap up. So we have 44% of our participants saying that, yes, geopolitics will have the biggest influence on oil markets. I would like to know, and then 33% say it is OPEC plus cuts. I would like to know what you are saying. Peter, what do you think about geopolitics?
Well, I voted for geopolitics, and I do think that they're going to play a very significant part as far as oil and price over this second quarter. I think there's many hotspots that we're seeing start to flare up, and I wouldn't be surprised that oil's going to have a spike in this second quarter. I think there's a fair bit of uncertainty as far as rate cuts, when they're going to materialize. The inflation story, I'm not sure, is under control. And all of these factors are going to, I think, impact price. And it's going to be, I think, a very dynamic 13 weeks of trading for the oil markets over Q2.
Because with Chinese bearish outlook for some time, it was like more China, which was, let's say, regulating China demand, which was regulating the markets. But now things changes. James, your thoughts about it?
Good. So I guess on podcasts like Gulf Intelligence podcasts, it's always good to have a contrarian view. So I was interested to listen to what Peter said there, and he has said he voted geopolitics. I'm at the other end of the spectrum. I actually voted for the US economic outlook. What I found very interesting, what Peter said there, was he was very much focusing in on geopolitics. And Peter, obviously, come back if I'm not hearing you correctly. But in the event, in terms of a black swan event that might relate to something that's happening right now, but it's a black swan event over and above what we've got right now. And the reason why I say that is because Palestine isn't a hydrocarbon producer. The Ukraine isn't a major hydrocarbon producer. Obviously, we've talked at length around the Russian position just now. You know, a couple of the things which were pointed out: Russia taking a much more, I think, conciliatory position within OPEC, et cetera, and working out where it fits in terms of its production. So for me, I focus back in on some of the stuff we talked about earlier on, which is that the United States already exercising a political influence over Ukraine to stop flying drone attacks onto Russian infrastructure. Clearly, the United States taking a changing position with regards to what's actually happening in Palestine. Now, black swan event aside, which can always happen, of course, I therefore focus in on the fact that the United States political situation requires a relatively stable oil price going into the elections, and that suits both Trump and Biden, and I think, but particularly Biden. So I think Biden will exercise increasing influence where they can to keep that price stable. That's influence on OPEC and OPEC production, it's influence on the Ukraine, and it's also influence in other geopolitical events that are happening. So for me, I guess it's a little spin on what Peter said, but I think it's the role that America will play into that geopolitical environment with regards to stabilizing the US economy over the course of the next 12 weeks is how I read it.
We are running out of time. It's 2 minutes past 11, but I would like to have your point of view, Jamal, just in 10 seconds. What did you vote?
I voted for geopolitics as well, and binary set of issues going on there. I think the key thing is when we talk about Palestine, when we talk about Ukraine, there has been a little bit of a stability that's settled as far as market perceptions of what's going on, and I don't think that can hold. Now, that could be in a bearish or a bullish way. Things could be coming to a head for a further outbreak with Lebanon, with Palestine, or it could completely, calm down, you get a ceasefire, things like that. But the same thing too in Ukraine, you're heading into the spring, into the summer. So could the fighting heat up there, especially going further afield, like we've seen with the drone attacks, if the front lines are have stabilized.
Thank you very much. So yes, 2 minutes past 11, we have to wrap up here. I would like to thank our speakers, James McCallum, Peter Maguire, and Jamal Qureshi. Thanks a lot to Gulf Intelligence team for hosting me today, and have a great day.
Thank you.
Thank you, James. Thank you, Jamal. Bye.
Guys,
all right, thank you. Take care.
Bye-bye.
Bye-bye.